Look in this next session in more detail at section 42, share for share transactions, and more broadly, asset for share transactions. The key criteria for rollover relief under section 42 are as follows. Firstly, the transferor must be a person, which, as previously observed, would then include, amongst other things, a trust. This provision or proviso is devoid of any reference to the residence of the transferor person. Accordingly, a non-resident person may affect a section 42 intra-group transaction provided that the assets flow to a South African resident company. It is further required that the market value of the transferred assets must equal or exceed, in the case of a capital asset, its base costs, or in the case of an item of trading stock, its tax value. Okay? The transferee, as previously noted, must be a resident company. The consideration for the transfer of the assets must include an equity share or equity shares in the transferee company. It is ordinarily required that the transferor must, at the end of the day on which the transaction has been effected, have a qualifying interest by way of the holding of at least 10% of the equity shares in the transferee company. Under a recent amendment, that criterion has been supplemented by a requirement that this holding of an at least 10% parcel of equity shares must also confer upon the holder 10% of the shareholders' exercisable voting rights. Okay? There is an exception to these rules. In fact, there are two exceptions. The first relates to full-time employees. If the transferor is or is to be a full-time employee of the transferee company or a full-time employee of a controlled group company in relation to the transferee company, any percentage of shares will do. You don't have to have a minimum 10%. The notion of a controlled group company in relation to the transferee company turns on the transferee company having an at least 70% shareholding in that company. Essentially, you're looking at a company grouped with the transferee company. And again, if you're a full-time employee of either the transferee company or such a controlled group company, and you continue to be thus employed for 18 months, you will qualify for rollover relief. Okay. There is also an exception from the 10% requirement if the company in question, the transferee company, is a listed company. In such a case, again, any percentage shares will do. Okay?
Sorry?
Yes.
The period of 18 months, is that in all circumstances? In other words, death?
No. Death is one exception. Yeah? Death is one exception, and subsequent rollovers, yeah? Subsequent transfer of the assets by way of sections 45 and 47, yeah, will be further exceptions. Yeah?
So only death or rollover?
Death or a subsequent rollover. Okay. If, yeah. Okay. It's this 18-month rule operates at one level in respect of full-time employees. Yeah? If they don't maintain that full-time employment for 18 months, the rollover relief will be negated. Yeah? In respect of those cases where your qualifying criterion is a 10% shareholding, yeah? If you dispose of any of your shares within the 18-month period, yeah, it will not disqualify the initial rollover. There is another form of sanction. The sanction in this case takes the form of any still retained shares, yeah, being subject to a deemed disposal at market value. Okay? Now it's important to appreciate that that sanction, a deemed disposal of retained shares, can only be brought to bear if you have retained some shares. Okay? So if, for example, after initial Section 42 rollover, yeah, and within 18 months, you take your newly acquired shares, yeah, and you subject all of them to a subsequent Section 42 transaction, yeah, that can be freely done, provided you transfer all the shares under that subsequent 42 transaction. In which event there will be no remaining shares that are subject to the sanction of a deemed disposal at market value. And if your subsequent transfer is again affected under Section 42, you're now doing a share-for-share exchange under Section 42. There'll be a deemed disposal of those transferred shares at base costs on an application of Section 42 to that succeeding transaction.
Sorry, so just to understand that, if there was a subsequent transaction that was shares and cash,
let's
would that deem a transaction to have taken place at the original date?
I'm being asked, for the benefit of the webinar listeners, if you were subsequent to initial Section 42 transaction, to again then engage in a further Section 42 transaction, pursuant to which you take your newly acquired shares under the initial transaction and you transfer them to another company, again against an issue of shares. Yeah? That would be fine if it's only an issue of shares. It would be a qualifying transaction under 42 also if it were an issue of shares coupled, yeah, with an assumption of such liabilities as are envisaged in Section 42 sub 8. Yeah? But if you are going to combine the consideration for a transfer of assets, yeah, if you're going to combine an issue of shares by way of consideration for transfer of assets with cash, yeah, then you are going to get only partial rollover relief. You'll get rollover relief to the extent that your consideration for the asset transfer took the form of shares. If it's cash or the creation of a loan account, yeah, you have only pro rata rollover relief. Okay?
But if that transaction took place within 18 months,
yeah,
would that deem that the disposal at market value on that portion that wasn't held for longer than 18 months would have taken place at the first date, or would that be the second date when you accepted cash as part of consideration?
It's important to appreciate that if under a succeeding Section 42 transaction, you took all the shares that were issued to you under the initial Section 42 transaction and transferred them again against most simply an issue of shares, yeah, you are not going to prejudice the initial rollover relief. The sanction in respect of a shareholder who was required to hold a minimum 10% shareholding for 18 months, yeah, affecting a disposal of shares within those 18 months, operates only in respect of any retained shares. If under the transaction you acquired 100% of the shares in the transferee company in that initial transaction, and you were in the later transaction to transfer only 82%, yeah, then your remaining 18% bundle of shares will be subject to a deemed disposal at market value. Okay? But if you transfer all of them, again, there is nothing to which this sanction of a deemed disposal at market value might apply. It applies only to still retained shares where you've sold some of your shares within 18 months. Is that now abundantly clear? Okay. What are the outcomes if you have performed a qualifying Section 42 transaction? The transferor will be taken to have disposed of its capital assets at their base costs, and the transferee equally will be taken to have inherited those base costs from the transferor. The shares that are acquired in consideration for the transfer of the assets will assume the base costs or tax values, as the case might be, of the transferred assets. Items of trading stock will be taken to have been disposed of and acquired at tax values. There'll be no recoupment of allowances previously claimed by the transferor on allowance assets, and the transferee steps into the shoes of the transferor in relation to the claiming of future allowances. There will also be a carryover of Section 24 capital C allowances. Now, do you need me to elaborate on what 24 capital C allowances might be? Okay. Nobody appears to be mystified by them, so I'll go on. There are key restrictions which we've been covering in passing, but let's reinforce that knowledge. If within 18 months the transferor ceases to hold a qualifying interest or ceases to be a full-time employee, there will be a deemed disposal of retained shares at their market value at the time of the asset for share transaction. Now, if you simply cease to be an employee within 18 months and you still hold the shares, then your entire bundle of shares will be subject to a deemed disposal at market value at the time of the transaction, which then effectively negates or reverses your rollover relief. Okay? The exceptions are death or a subsequent disposal of shares under Sections 45, 46 or 47. Okay? Those are the express exceptions. There is also another exception which we've been dwelling on, yeah? And that is if under a subsequent Section 42 transaction you dispose of the initially acquired shares and you dispose of all of them, yeah? You may do so without prejudice to your tax relief. It's expedient that we look at the question of coupling an issue of shares with other consideration. There will ordinarily only be partial rollover relief if the issue of shares is coupled with other consideration. You will get rollover relief to the extent that the purchase price of the assets is discharged by way of an issue of shares. The exception is an assumption of liabilities such as are contemplated in Section 42 sub 8. Now, those liabilities which the transferee may freely assume without prejudicing rollover relief at the level of the transferor are the following. They are firstly debts secured over the assets of the company which were incurred more than 18 months before the transaction, or otherwise, if within the 18-month period, incurred at the time of the acquisition of the asset. So you've bought fixed property subject to a mortgage within 18 months. That is debt incurred at the time of the acquisition of the asset. That liability may permissibly be assumed by the transferee. Beyond that, within the 18-month period, you may also assume debts incurred in the normal course of the business which is transferred as a going concern. So your trading debts, which were incurred by the transferor within the past 18 months, may permissibly be assumed by the transferee. Now there is a sting in the tail to all of this. If you've combined an issue of shares with an assumption of liabilities against the transfer of an asset, when you come to sell your shares, the liabilities assumed by the transferee must be added to the proceeds of the share sale for capital gains tax purposes. And that will be so whether or not those liabilities have subsequently been discharged by the transferee. Okay? Is that explanation or formulation clear enough? I see you're looking at me and you're somewhat mystified, are you? Yes? If, in consideration for the transfer of assets under Section 42, the transferor not only acquires shares, but has the transferee take over such liabilities as of the transferor as are contemplated in Section 42.8, you will get full rollover relief. But again, there is a sting in the tail. Yeah? The sting in the tail takes the form of the transferor on a subsequent sale of the shares acquired pursuant to the transaction, having to add the amount of the assumed liabilities to the share sale proceeds in determining the capital gain on the disposal of the shares. Is that clearer? Okay. Let's look at one practical application of Section 42.8. Okay? The BWZ Trust holds all the shares on issue in the XYZ company. The Trust also owes 38 million rand to the XYZ company. Yeah? That 38 million rand debt is secured over the Trust's shares in XYZ company. Now one would traditionally and very simply do that, yeah, by insisting that the debtor company, that the shareholder in the debtor company hands over its share certificates accompanied by a share transfer form executed in blank. So if you want to sell the shares by way of security, yeah, you can do so. All right. Now, you'll appreciate that when the trust owes, or where a trust owes an amount, yeah, to a company in which it is a shareholder, yeah, it is going to be exposed to dividend tax unless, yeah, the trust in this the company in this case were to exact interest at the official currently 6.5% rate. Yeah? The dividend tax exposure in this case is not as large as it used to be under the old dividend tax regime. Under the old dividend tax regime, your dividend tax exposure was determined by reference to the amount of the debt. Yeah? Under the current dividend tax regime, your dividend tax exposure is limited to the difference between the official rate of interest and such a lesser or nil rate of interest as the creditor company might exact. Yeah? But even so, 6.5% on 38 million, yeah, is a reasonable amount, and this is a recurrent expense to be borne by the trust. Okay? Against that background, what might happen if the BWZ Trust were to exchange its shares in XYZ for shares in a new company, ABC, so that ABC Co. is interposed as a holding company between the trust and its former shareholding in XYZ. So share for share exchange, pursuant to section 42. The BWZ Trust sells its XYZ shares to ABC. In return, ABC settles the purchase price by issuing shares in itself to the trust. So ABC now is an interposed holding company. If this were to happen, what might be the result?
No need for interest.
No?
No need for interest.
No need for interest, no dividend tax exposure. Why no dividend tax exposure?
Holding company relationship.
Because under the current dividend tax regime, there is no dividend tax liability in respect of dividends attributed to a fellow South African resident company. Okay? Any distribution in favor of a fellow South African resident company by another South African resident company is free of dividend tax. Yeah? Okay.
Excuse me.
Yes.
Sorry, I just want to jump back in your example. If I understood you correctly, previously you said if XYZ now disposes of that shares...
BWZ
Yeah, sorry.
disposes of its XYZ shares to ABC. Mm-hmm.
ABC I'm sorry, let me just add that to ABC company, if it disposes of shares subsequently, then, well, I think I might be a bit confused here. So, when will that, the assumed liabilities to be added to proceeds on the disposal of shares? So,
If subsequently the BWZ Trust were to sell its recently acquired shares in ABC, yeah, then the proceeds on the sale of the ABC shares would have to include the amount of the liabilities assumed by ABC. Okay? Is that clear? Okay.